You know what's making this week's analysis particularly difficult is that the US dollar is basically in the middle of its range, while a lot of other assets that we look at are pretty close to liquidity pools or areas where we'd look for reversals. So I'd like to see how this week plays out. We got to be patient, and let's dive in and take a look. Right, so on the dollar weekly time frame here, we've had a nice double top left here, and we've retraced back to the 382, and we've just consolidated now for 2 weeks. So what I'm seeing here are these two gaps, imbalances below discount level, the 50% mark of the range that we've left in the last several months, right? So this is the beginning of the year, 2026. So within this year, the discount range is actually right below these two candles here in an imbalance. And to me, that signals a willingness for the dollar to at least come sweep the lows here, which we talked about last week, and it didn't do that yet. A couple consolidation weeks and a down candle with a wick, or a down and then an up candle, would make sense to me, right? It looks like, even though despite this consolidation being broken to the upside, if this is a true Wyckoff accumulation, right, and this is the spring, what I would not want to see is the dollar come below the 50% of the swing leg, right, that breaks this high from the sweep of liquidity under here. So if, the institutions are basically what you'd say defending this level of a sweep of liquidity, the 50% mark, which is basically the bottom of these three green candles, which is the order block, the breaker, in ICT terms, right? We've retraced into it, but now we should basically be respecting the mean threshold of this entire leg up here of the breaker. So I wouldn't want to see much of a body below the 50%. We've talked about this level at the super discount of this range in this weekly gap for quite some time. There is a double bottom here, however, and it may just get swept, right? And we might leave a body at the 50% of this. That's a long way to go, in my opinion, for what look like good reversal points on the euro, the pound, the indices, gold, silver, kind of a lot of different assets. The only thing that would correlate with such a dump in the dollar right now is crude oil. And as a contrarian viewpoint, crude coming down with the dollar, because lately they've been relatively correlated, might make sense, might make that narrative. However, again, if this is to be a spring out of this Wyckoff accumulation, then I don't want to see too much of a dig into this whole down movement, right? And back up. If we do take just that down move, okay, 50% of that down move is the top of this gap. So technically, for discount, the US dollar could wick into the super discount of its most recent range, which falls within that gap, sweeps this liquidity, and then we would be going up, presumably, right? Leaving this double top right now when we haven't even stretched into premium of the last 5 years of the dollar index after breaking out of this doesn't look like enough of a liquidity grab to me. We didn't even take this wick yet. So that's where I'm struggling with the dollar. We're basically in the middle of this range here from the last 2 months, and in the middle top, we're in premium of the beginning of the year here. So it's hard to say that how far it's going to come down. I do think discount is in play below these lows, which we talked about. Certainly this low, which we didn't even sweep last week. So on a daily basis, it absolutely looks like the dollar is headed below this low for sure, below this low and into this gap. Possibly something drags it below this double bottom into super discount, into the weekly gap, into the discount of this breaker block, basically, right? All the down close movement that then got shot through and broke this high, right? So, we could be seeing something move the dollar really deep into this consolidation. But again, having basically started to leave to come all the way back to a super discount seems unlikely, looking at the other assets we look at. Not saying it's out of the question, but if it does get down here, I will be buying the dollar pretty aggressively by selling euro or selling something else against it, just based on the fact that this to me looks like a Wyckoff accumulation that will presumably be running liquidity at this high and into a premium of its last 5 years dealing range over here, right? So I want to see it into this gap above the premium level here, preferably into this gap where one standard of the consolidation we had for 2 years would be resting right up in here in a premium level before the US dollar takes a bigger dive. So that's what I'm looking at dollar-wise. How that plays out on euro then, right? In this most recent daily dealing range, okay, we have now closed above the super premium mark. So that is telling me for sure that the dollar is going to weaken a bit more. We have broken this trend line, which again, not important necessarily, but it is potentially a signal that while this might look like a false breakout and we could be coming back down, it does look like there's a bit more activity on the left side of the curve here to kind of match out on the right side of the curve before the euro will take a bigger dive. So as much as I wanted to be bullish on the dollar, in the shorter term to then see it reverse, I don't think we're quite at the reversal point yet. And, price action is telling us that we had a double bottom sweeping this liquidity, right? So now within this daily dealing range, okay, from here to here, or even here to what we have now established as a new low, right? The super premium of that dealing range now is back up here. We do have the same gap that's from the US dollar indicated on the euro here. And this double top here is not as smooth as the double bottom on the DXY. So the DXY double bottom is fairly smooth there with that gap on the euro. we're not seeing that, and it's actually in that gap. So I would expect euro to possibly be weaker than dollar and not sweep these highs, but it could get into the gap, the super premium of both this dealing range and the apparent dealing range that we're looking at projected. If we have a projected dealing range down to say 108, right, which is one standard deviation of this parent consolidation here, that one standard deviation down puts us at 107,388 into this gap. And if we were just to project a new dealing range from this high to a low that may form over here, right, getting back to a super premium of that projected dealing range wouldn't be out of the question, right? And we'd get into some of this imbalance here where, again, we left only a wick here from a while ago. And I mentioned, well, we've had some good bearish activity since then, that this wick seemed like a very weak run into this imbalance. What we had seen from this price action just looked like a weak high. And now maybe this is the time we're going to come just run that, sweep it a bit, and come back down. So I'm seeing some bullish action on the euro for now to cooperate with a dollar decline just briefly. And ultimately, I do want to see something more like this, a step down. But the bullishness on the alternate currencies and bearishness on the dollar, where the liquidity pools on the dollar just seem too obvious to let this sort of hang out and drop lower. Although there aren't as many obvious runs on liquidity here where we can just sweep and reverse. So that's where the euro, I would expect it to get into a super premium of at least this dealing range that we've left here for the last couple months. So I would expect something where we're going to push through the 50% here and potentially make our way up to the 117s area, and certainly sweep out what look like some nice flat highs here into this imbalance where we took the liquidity and broke through this low. So that's where I'll be looking at euro for potential reversal points. And am I going to long it? Maybe. I mean, I think I want to see how weak the dollar would come out. And see how it reacts to the different liquidity pools that we most certainly will be tapping. This low discount level, right? Once we hit equilibrium, how do we react from this imbalance, right? Because we had a nice push up, back to retest, and pushed up and through. So does this hold as an inversion fair value gap? I'm inclined to think it might, just where it falls here on the breaker pattern. But is something stopping us from getting these lows swept? Absolutely not. And what would that look like on the euro? Again, I would see that as possibly reaching up to this gap and at the super premium of a projected dealing range and back above the 50% the equilibrium of the consolidation, right? That's exactly where this 75% would be. So if we are to retap the equilibrium of the consolidation on the euro, that would be a opportune point to possibly look at shorts. Because on the pound, right, we've had this double top here for a while that was smooth, and it didn't necessarily have a correlating liquidity raid like we have over here on the left side of the curve. So we could very much, we talked about this high last week, and that we had closed below it until we had this big bullish candle. So now I do see this double top as where, when the dollar is retreating, the pound will most likely be aiming for this double top. So for the pound, I would see the liquidity sweep happening up at that level, right? The thing is, this week, there's very little on the economic calendar that would merit some kind of run. So maybe this is just a newsless, drift up for the coming, news catalysts in the next 2 weeks or 3 weeks, where the liquidity will finally get rated above this double top on the pound. And this high, I would think, stays intact, unless, because this correlates to the spring on the dollar. This would be the UTAD on the pound. It's the middle of the consolidation time range, right? So, it may have been premature to think we're going to just start dumping here, right? We have 1, 2, 3, 4, and we probably need a 5th high in here, right? To just kind of mirror out this Wyckoff distribution. And things in Ukraine are heating up. Maybe for now, Iran and the US have some kind of continued peace meandering going, so that the dollar could just weaken enough to give some liquidity raid a chance here before we then go down. So I do see this double top getting taken on pound, as it's looked fairly strong, but we'll be looking for a reversal up here in the 137 to 137.5 zone. And I do think this high stays intact with this imbalance here that really hasn't been run through, and the bodies are currently right in the same imbalance here. So if we mark that out just to be thorough about it, we have the bearish candle there, bullish candle here. Okay, so we've marked that out, and you can see the bodies here didn't close above it. We spiked through, spiked back down, and now we're probably headed back for that is what I'd be looking at, right? Just to tap that, sweep this high, and then fall off as dollar, wherever dollar is at that point, right? And it presumably could be as low as the super discount here into this gap, where euro would then maybe not be forming a new high to break here. So that's the Forex challenge this week, is how far is dollar going to go with euro correlated upwards and pound correlated upwards again. So I think euro probably hits the super premium, pound takes this double top into the inverted gap here, and then we can see that maybe this week and into next. Most likely we only have 5 days here, so I would see pound pushing up. Yeah, I'd probably long it to get up to above these highs, and then I'd just lay off and see how we react in this zone. Okay, precious metals then. Gold, we know we really just saw kind of a consolidation week, although there was a lot of movement here, right? We did hit the super premium of this range that we have been looking at. It's possibly not done, right? If dollar's going to weaken, we might get one more big spike up here in gold. However, it was not showing to me the same bullishness that I would have thought, given, we're seeing the indices skyrocket pretty much, and gold and silver really didn't have that same kind of oomph to the upside. And one thing we've been looking at here is kind of this top that was on the left side of the curve to on an adjusted basis to mirror it on the right side of the curve, right? We've been looking for gold to run up on this consolidation, the liquidity into a premium market here. And the only question was really how far it was going to go. And it obviously had missed this first projection we had, and we kind of analyzed that as it was happening, that we'd probably see a much larger push on gold. We're essentially right there where we have projected. So is gold possibly done here? We've hit the super premium of the stealing range. We have other dealing ranges that we could draw right here and here. And ultimately, this would be the super premium that raids this candle that cascaded downward. So do we get all the way back up here? I think that's highly unlikely still, based on what we saw. I'm going to leave this back at where we were here. Okay, so from a apparent dealing range perspective, we did close below the 50% of the projected parent dealing range from here to here, and we closed through it pretty hard with this displacement candle right here. So while we are right now in that imbalance, I could see gold possibly getting up a little more, but when we look at silver, silver is also, it's probably consolidating here to wait to do one more rip to the upside, maybe tap the super premium of its own dealing range from the last several months, right? Silver had a much cleaner push through the 50% than gold did. We just wicked it and we kept going. So consolidating at the 382 here is pretty clean. We've lifted off of that to essentially take any early shorts that were in here. Do we wick up to the 50%? I don't think so, honestly. This gap that we have outlined from a while ago, maybe it for silver. And so I'm not seeing gold and silver really making this huge run up, especially given copper. Look at this. We have this trend line. We finally rated this double top that we've been looking at. We hit 4 standard deviations almost exactly, right? We came just barely short. So do we make one more run up to wick that one more time and actually complete 4 standards? Possible? Yes. Likely? I don't think so. 1, 2, 3 drives. On the third drive, we really pushed through and rejected strongly. And since then, we haven't been able to hold any sort of super premium or premium level on copper as we've started to come down. So while gold and silver may show some bullishness, if we are to take this last dealing range here, right, from where we started the ascent back, and we take the ultimate high that we saw here, and we have this trend line that's just asking to get knocked out, I think we can push back to what would be a super premium at 66320, or in this last bit of consolidation here, I've marked that dealing range from this high to this low, and the super premium there is 66605. Okay. And if we wanted to just measure that one a little bit farther to the top, right, the super premium would be back at 67725, where we've hit super discount of this last push down. So we could be seeing a pushback into premium, right? And if we are to measure where that is on the last high that broke structure to the downside, we're closed right at equilibrium on copper. So if I'm going to short any metals, it's going to be copper, and it's going to be probably at the 6.6600 level at the super premium of the last leg down, which still puts us in premium of the last ultimate top here to the latest low. So that's where I'm looking to short copper. I think copper's, it had its bullishness compared to the others. It made its high on Wednesday, then gold made a high on Thursday, and silver couldn't make that high the same way either. On Wednesday, it had the high with copper, but copper's was much stronger and was the one that took the liquidity. I'm sorry, Thursday of last week, copper took the liquidity. Gold actually did it. Gold didn't. Gold was still making its run this week and took it on Thursday of this week. Silver did it on Wednesday of this week. So that's where I'm actually still quite bearish the metals, and I want to be short now, but where the dollar is and where oil is, it's harder to make a more immediate case to be short the metals. But watching copper make that run through these highs last 2 weeks ago, and then be very weak this past week, silver and gold just kind of hanging out, but making their runs more this past week, have let me think, okay, gold and silver probably could make one more spike on these highs and not be making a run to the downside yet, while copper may make a lift into its range, not take, I think this high is staying, and just get short copper somewhere up in its premium range. On the crude oil side of things, we're literally at equilibrium of the last 2 months, 2.5 months here. So this is where the dollar and crude oil are really kind of screwing with the rest of my analyses. We did tap the super discount of the last 2 months range. We also finally did dig with this low down into this weekly gap, right? And we did wick price to fill to the body of this candle as well. So, and we're at the 0.618 of the parent dealing range. where does oil go? And I think, as most people would guess, it's probably more fundamentally dependent on supply constraints in the Middle East. That said, technically, it looks like it would go down with the dollar to at least clear this low and for sweep it to form a double bottom here before it goes up, right? If we came down and we go up, we have a tap and then a double bottom before another increase. But to me, this just looks like a market maker sell model, where this is the low that would, if we're forming a double bottom to again be bullish, it's going to happen in this gap in a very steep discount of this dealing range, right? We did leave this double top here, so again, it still is possible that oil makes this run up. I just don't think it's worth trading with the volatility that it could be, and it's right at equilibrium, right? If we get way down here at the 67 mark again, and dollar and other assets look like they're inversely correlated with oil, they look like they may make a reversal, then it might be worth a long here. Certainly, we'd projected possibly down to clear out all these smooth lows before, and crude wasn't getting as much attention in terms of price action until this happened with the Middle East. So it's possible that we just come for this low. I do see this as a market maker sell model where we had a gap down, a break of this low, and we've simply returned to close in this gap down with bodied price action. If we zoom in on this, right, we have a lot of filling to do. We have filling to do here, but we gapped up, gapped back down, and right at the bottom of this candle, the body here, right, we have 2 wicks now trying to fill that in. And what we might see is a little spike up, but I do think some contrarian view, counterintuitive, oil could be coming down. Will I short it? I don't think so, right? But if we start getting through this candle to the downside with a similar displacement, and we mirror this imbalance up with an imbalance to the downside, then yeah, this low will be taken. This gap will likely be a target to fill. This imbalance will also be in play, and this low, which has looked weak for a long time, is in play. So to be swept as liquidity targets, this imbalance, bullish imbalance, this low, this weekly gap, and this imbalance, and finally this low. So you have 4 targets to the downside if oil is starting to show, which it can with the dollar. This is why I'm thinking if the dollar is going to retreat, as it looks like it will, oil probably will retreat with it. They've been quite correlated recently. So that should bring oil down, and most people might be afraid of that as a volatility play. If something does happen, oil can just spike to the moon. So being short doesn't feel very comfortable. Again, there's a lot of other things to trade. So does it make sense to be short oil in this environment? I personally don't think so. Technical analysis is telling me that this is going down here to accompany the dollar on a run to the downside for the short term, and then probably a reversal. But that's really it for oil on this. I don't see it worth trading right at equilibrium here. Is there a long way to run? Sure, but there's also a long way to run to the upside. And if it's going to start doing that, I have no interest in being biased short for any length of time. Soybeans, basically been seeing this play out. We wanted to see with the WASD report something like this wick, right, where we would wick into, clear out these highs. And now the only question is this bullish action actually going to continue up to maybe fill in some more of this gap and get to more of a premium of this leg down? And that's hard to say. I'm going to be shorting it anywhere in the premium zone here at 1 or 12.12, right? And possibly even lower, because what I would see is this holding, if this is going to be a nice clean market maker sell model, right? We already went into the premium here from the last displacement lower, and we did double bottom here, which could put us all the way back up at 12.10 once we have a retracement, give some bullish action to this gap, missing price action here. So if we do have bullish action back up to 12.10, kind of close in that with some body, then we're in super premium of this last displacement down. I would like to short it there. However, to be a cleaner market maker sell model, I don't want to see it go too much beyond that, beyond what it's done already. So if it's going to reverse, maybe with oil and with other commodities, then this could be it. It made its WASD sweep, and then it's just retesting that wick with a body, and it could be on its way down. So right now we're kind of in the middle of this most recent dealing range, and I'd like to see if it's going to start displacing down, then I could be looking at a short below the WASD wick here, and just that's my stop. If it does show some bullishness, look to reshort around 12.10, 12.12. And I think similarly on soybean oil, right? So we wanted to see this run up to close in this gap. We had it. We have displaced back down, and we're consolidating a bit in the discount zone of this last run down. So with the WASD didn't impact soybean oil as much, we could probably get another wick above all of last week's price action and then be dumping. So soybean oil, I'd be looking at, because we have this as a dealing range right now, which is in this dealing range. Okay, so we could actually put 2 dealing ranges on here. One is from the most recent double bottom, which is very suspect to get taken out at some point. It's just how much of a premium are we going to build into that before we go to run this? We could be there now, because I'm looking at the left side of the curves here, and we're close to that level here. If we be adjusted, right, this high is maybe the one that would correlate to something over here on soybean oil in the super premium of this range where we gapped through it. That 75 super premium is directly in the middle of that gap, and the super premium of what we just drew is the bottom of this body. So what we just drew, if we want to get all the way to super premium at 71.85, that is a very clear short. And anywhere between 70.83, which is the 618, and 71.85, we would be hitting the middle of that gap. I'd be looking to get short soybean oil at that point. We did look a long time ago at whether this top was going to be the one that it takes, and it looks like that's as far as it wants to go right now. We have a double top. We look, we broke down and we went back up for a failure swing here. So I don't see soybean oil really making another big run. And on the daily time frame, a premium at least 69.93, but a super premium somewhere within either the prior leg up or the current leg down is going to be in your 71.16 to 72 zone. So that's where I'd be looking to short soybean oil, and how that might correlate with soybeans. Yeah, soybeans might get back up to the 1210, 1212 area, kind of to match maybe this high over here before it wants to really tumble. But I think the WASD wick was exactly what we wanted to see, where it looks bullish, but ultimately it's probably just going to get itself run out, and then we'll be bearish again for a sell model down to clear these lows and actually get into a bigger discount of what we have drawn as overarching dealing ranges from before. These are on an unadjusted basis, right? These prior dealing ranges, we have not even gotten to a super discount. We barely tapped the equilibrium of this range from a year. Oh, this is 15 months now, 15-month dealing range. And we just tapped discount. So now that we've taken this double top, we're very much likely to at least come back below this low into the discount here and into super discount of the last yearly candle starting right here. So I do think this was the high that will be for the most near term, and we're going to see this trend line continue to get broken to the downside once we make one more displacement through this most recent low. So that's the story on soybeans. Indices are kind of messy here, at least with projected dealing ranges and such. But again, the 4 standard deviations that we had drawn from this manipulation leg down on the NQ has not been hit yet. So I have projected dealing ranges here from our recent low, which is a repricing candle. There is no wick on the downside to this candle. And if we are measuring that as a projected dealing range up to the same level as 4 standard deviations from this run on liquidity, okay, you can see that the current dealing range here and the projected dealing range that would be the entire low to the ultimate high, these levels are lining up nicely. See, 50% on the projected dealing range is right where these bodies ended up closing and rejecting. Same, yeah, I had drawn it out already before here on the previous contract, the June contract. Now we're on the September contract, and hopefully we don't roll again to make this even muddier. But what I'm seeing here is that we have consolidated a bit in premium and displaced upward through the 382. So a couple scenarios here, but I'm seeing NQ just completely rip out all this liquidity and flat highs at the top side. And again, if we don't see a pretty sharp rejection up there, then maybe the dollar is headed for much lower pricing and the equities can continue to rise. I'm not seeing that, but I'm seeing a weak enough dollar giving the equities a chance to distribute here at the top around 31.7 in the NASDAQ. And certainly ES has already blown through its top, right? And YM has done the same thing, right? YM took out this top, and that's what we wanted to see. We wanted to see it hit 55,000-ish almost. So it basically did that. It's looked a lot weaker than the other indices since then. And I wouldn't be surprised if it hits this high, gives a little reaction to spike out some of this liquidity back to a super premium level maybe, and then make its tumble. So the Dow just looks like a capitulation stop run up to the 4 standards that we wanted to see it hit. And it, again, was just shy by like, I don't know, 20 handles or something. So for me, that could be good enough when I see the price action of the other ones. But with YM shooting through, ES shooting through, and continuing to show some more bullishness up to what looks like the 4 standard deviation mark at 78.90 area. Maybe it hit 7,900 as a psychological level. But combined with NASDAQ not quite reaching here, I'm pretty certain that NASDAQ will now be sweeping all this buy-side liquidity up here that the Dow has already done, right? The Dow already did it, and it would just make another spike double top here. The ES is showing the most strength for now, but when it wants to reverse, I think it'll be a pretty stark reversal. And just to show the correlations here, the Russell has now finally taken its relative equal highs here with a big weekly push. So we could see another run. And the Russell here is being a little trickier. There is not a very clean projection of 4 standard deviations up from this run on liquidity, but it actually wasn't a run on liquidity because, I mean, it was, but it basically just went to this order block here. and then it went up. So it's not the same. It's actually a higher low, whereas S&P and NASDAQ, this is a lower low. So maybe I'm just drawing my dealing ranges all wrong. Maybe I need to be doing it from this consolidation. Why don't we do that now? If we run 4 standard deviations on this consolidation, that's the thing. I think I looked at this, and if it's 3 standard deviations, that aligns with the same level as if it was 5 standard deviations from this run here. That was a failure swing on the Russell. So 3 standard deviations of this consolidation, where all these are very, very equal lows here. So to me, that wants to get run out at some point by some major event. And when is that? I think it's coming soon. But again, so if it's 3 standard deviations, I've marked that at 3140. It would give the ES a little bit of room to run, the RTOI a little bit of room to run. It gives the NASDAQ room to clear out and finish up its dealing range to get above these highs, and it lets YM actually just spike up and clear some of this liquidity, maybe wick the bodies here, but not form a new high. So essentially, NQ, I would expect to take out all this and make a new high and somehow form a double top before a reversal. The ES has already done that, right? So it will continue upwards until hopefully around 78.91. At most, I'm seeing like 8,060 something. We'll be looking at all of them kind of together. And then the YM should be weaker and be starting to attack the downside if this all plays out. So again, the weaker dollar this week and next look like, aside from YM, it looks like ES and NQ and RTY should continue a bit of a march upward until NASDAQ takes its highs, right? ES and the Dow have been somewhat more correlated lately, and I think there's more weight kind of between those that aligns. But basically, as NASDAQ takes these highs, I think that's going to be the telltale time to see where the reaction point is. If it's at this 4 standard deviations with the projected dealing range that I have, it's going to be, for me, very bearish. I've been just waiting to be short the equities, but every sign is still saying, wait. This smooth top that was happening around when we first started to call some bearishness, I mean, we had some bearishness, and that's fine, but this was in question, and obviously it will be taken. So if NQ falls short here, then we can't be bearish on the indices anytime really soon. But I don't see that happening. I see a weak dollar letting the indices just plow through this liquidity, and then we want to see what happens in terms of a reversal. So that's where we are on the indices. Finally, Bitcoin. I can't fathom how bearish and how just weak this asset has been. I've just wanted to see something to the upside here to short, and it's not giving it to us. It's this high and this high are relatively equal, so that tells me someone somewhere wants, and there's an imbalance here. Okay, so patience. I wouldn't get short Bitcoin yet, as bearish as I am on it. This double top now is really just asking for the time to be right to blitz through it into this imbalance. There is basically a repricing candle here, so no wick. That's above the equilibrium point of the dealing range that we've drawn here. So I expect Bitcoin at some point to make a run to one of these levels. And until it does, I can't be short, and I don't want to long it because all it's doing, I mean, if the theory is right, if the narrative is right, this is going to be fast. Whichever level it's going to get to, it's going to be violent and it's going to be fast so that no one can basically react in time, right? It's going to be quick up, quick down, so that whoever was buying on the way up is going to be completely trapped and is going to get smoked on the way down. And similarly, if you're shorting now, you're going to get knocked out, most likely. I mean, this is my narrative on it. You're going to get completely knocked out on its way up because it's going to go farther than you think. So my guess is this middle one, right? I've been guessing this for a while, the super premium of this range. Although this high does look kind of weak, right? So is 88,000 or even 100,000 at the super premium of the projected dealing range out of the question? No, 100,000 seems weird that we would take this high. But again, if it's going to get up there, I'd still take a chance on a short that we're not taking out the all-time high, because all this sell side liquidity is waiting. And there's no way that this is the long-term low in my book at 50,000. There's no way this is the long-term low when we've come all the way back to this to not sweep it. And again, if we don't take liquidity to the buy side, okay, here's the counter narrative. If we don't take the liquidity to the buy side first and then dump, then I may change my tune a bit on the bearish narrative on Bitcoin. If we just dump here to the super discount and we sweep this liquidity and we recover to this range, then we can talk about a more bullish narrative on Bitcoin. But that's not what I expect. If dollar is going to go down, Bitcoin should be ripping out this, blitz through this double top into this imbalance at least, if not completely liquidate the discount side of this and get back up to equilibrium and possibly higher, rip out this high to the point of this break of structure, which broke both of these lows on this run. So I think this lower scenario is highly unlikely. This is fairly likely, and this possibly is the most likely back into super premium of this last leg run that really knocked out a lot of structure right into this consolidation. So But again, it's probably going to look something like this, where the buy side liquidity just gets completely rated, whichever stop it's going to make, and then it's going to flush to the downside with as much vigor and vim as it went to the upside. That's my Bitcoin narrative. I'm sticking to it. Right now, we just consolidated to make it liquidity on the bottom, liquidity on the top, and woe be to those who are in a position right now that don't want to. I just think it's going to rip these and flush. So we shall see. That's enough for today. I appreciate your attention. Let me know if there's any other assets you want me to look at. But taking these dealing ranges into account, we're in the middle of a lot of them. So this week may not be the best trading week, but I think you can look early in the week to see what price action looks like, which early week liquidity pools get swept, and see if we have a bullish reaction on a lot of anti-dollar assets, or reverse correlated assets with the dollar. And that's what we'd expect to see. So if that aligns, then our bias can be to long euro, long pound, long Aussie, long indices, maybe long gold, silver. I wouldn't want to long the metals right now. I think the dollar was going to have the cleanest story, and so the assets that correlate or inversely correlate with the dollar, like Forex futures or Forex pairs themselves, make the most sense. And at least for the short term, right? And until the dollar is going to show us a bit more of a direction that it has swept liquidity, euro or pound have swept liquidity, and potentially the other assets are more positioned in a dealing range or a projected dealing range to reverse. That's our narrative, and we'll stick to that until we see otherwise. All right, cheers. Have a safe week, safe trading.